Morning all, and thank you, Minds and Money, for hosting us both today and everybody else. This is a little bit like the Laurel and Hardy show. We've done this for every couple of years for the last, I guess, 8 or 9 years, and so the last 2 years has been a particularly, or the last 4 years since Evy and I had a chat. It was his colleague last time, and we've gone through a significant price increase in commodities. We've gone through COVID, we've gone through supply chain constraints, and now we're getting into the inflation world. So a lot to cover in half an hour. Evy, maybe just start off with a general overview of where you see the industry today, and perhaps also relative to where other cycles have been, because I think the commodity cycles, we all know, does relate to history, and price is the key kind of determinant of that, but there are lots of things which are particularly nuanced in this case. So where do you see us now, where do you see the next year, and perhaps where we are relative to previous cycles?
Yeah, thanks Jamie, and thanks to Minds and Money for having us here again. We've obviously done the right thing in the past to get re-invited back. We are at a fascinating point in the cycle right now, and I think that this cycle has all of the hallmarks of being one that has much greater duration relative to previous ones. And I say that with a high degree of confidence, because when we think about the essential nature of resources towards the carbon transition, we're going to see, decades of demand growth that's likely to be higher than expectations and higher than historical demand growth rates. So on one side of the equation, we have this very supportive outlook for commodities demand. On the other side of the equation, we have all of the pressures that resource companies have been through over the last kind of 10 years or so. The long down cycle from the previous peak in 2011 through to the low point in the end of 2015. The repairing of balance sheets, the rebuilding of trust with shareholders, and the kind of the overall distributions of capital back to investors has left the companies in an incredibly strong position to be able to think about the future, but also with a great kind of robustness to their capital allocation frameworks. And they've shied away from building things for the sake of growth, and they've also managed to think about their portfolios with regards to rationalization. So the underlying companies are in great shape, and supply is being constrained by a number of factors. First of all, the increased discipline on capital allocation. Secondly, the trends around ESG that are making it much harder and substantially more expensive to build things. And the increased time it takes to bring new capacity to the market means that when you look at that in the context of the demand profile, the gap between supply and demand is likely to be large, varying by commodity, but lasting for many years into the future. So to come back to the start point, I think we're in an incredibly lucky position. Companies today are kind of harvesting the benefits of this, but I think there's a really exciting financial future for this space. And it's in the hands of the company's management teams to be able to get that. We don't want them snatching defeat from the jaws of victory.
So I'm going to come back to valuation and things in a minute, but maybe we could just try and identify the differential between the gold space and the, I'll call it base metal space, but really I guess what everyone focuses on is the battery metal space within that. How is the differential do you see going forward now? Gold clearly maybe being impacted by inflation, base metals obviously having a completely new life to itself with regards to the battery metal space. How do you see the relative performance on those two going forward?
Yeah, I think what we're now starting to see from investors, when you're looking at the resources sector through the ESG lens, is which commodities are important for the future against how are they produced. And when you think about trying to explain to somebody why there is a need for disturbing the environment, for digging a hole in the ground, because it's essential that you produce copper or nickel or other commodities that are going to be absolutely integral to the carbon transition for the global economy over the next 20, 30 years. Yeah, it's quite an easy story to be able to tell people about why it's necessary to actually do that activity. I think when it comes to other commodities that don't play that role, it becomes much harder to justify why you're having to do the digging and disturbance in the first place. And I think that it's that need for gold companies to describe their relevance in the future. And we need to, the industry needs to think in conjunction with the World Gold Council about how they portray their story to young people today. I think, as I've always said, gold has been, a financial asset and a means of exchange for thousands of years. And I think it will continue to be that case a long way into the future. But we need to find a way of getting gold into circulation so that it actually becomes money again. I think the prospects of inflation are going to be damaging to paper assets, principally currency. And we're seeing people reach for alternatives with crypto and others. But gold is the natural place to turn to. And I think as gold companies start to understand that, they're going to be able to reassert their position back into the kind of relevance with regards to investors in terms of why they're doing the activities that they're doing.
So just talking a little bit further on inflation, I read recently that your economists at BlackRock said that they expect central banks to allow inflation to ride a bit hot for the time being. I hark back to the days of, I think it was 2008-9 or 7-8 when inflation really got away with itself, particularly in the mining space. And tires were very difficult to come by and all of that. How do you see that repeating itself? How do you see that in terms specific to the mining industry?
Yeah.
How do you see that? And has the market priced in some of those potential risks to the what has been a pretty golden era in terms of cash flows of the last 3 or 4 years?
Yeah, you're absolutely right. We have been through a long period of good margins, and we've seen an absence of cost inflation. You're right in terms of the BlackRock view being that we are likely to see higher rates of inflation than was previously expected. And even yesterday, Mr. Powell came out and said that we should be removing the word transitory when describing inflation, and obviously had the impact on the market that it did. So I think there is a wider understanding now that inflation is going to be stickier, and some of the things that people thought were going to fade are just not going to do what they had previously thought. I think when it comes to mining industry specific rates of inflation, you have to look at the underlying components. And when we think back to the previous cycle that you were talking about, one of the, outside of all of the normal gyrations around input costs, the one thing that is substantially different today than it was in the past is in the previous cycle, all of the businesses were investing and expanding at the same time. And that put an enormous amount of pressure on the supply of raw materials into the resources industry, whether it's the components for trucks, tires, etc., but more importantly, labor. Trying to get the geologists, the mining engineers, because they're all already working on projects. And so the labor inflation rate was just kind of exploded higher. We don't have that same rate of capital investment at the moment. And so that is a big difference between what we're seeing today relative to what we saw in the past. However, if you're trying to build a new plant today and the price of steel has gone up many times fold in the last kind of 12 to 18 months, the price of copper is substantially higher, or the price of oil is substantially higher. All of this is feeding through into that higher rate of inflation. And those are kind of outside of the control of the companies. We are starting to see the labor rates tighten up a bit. Anybody who's been flying through airports in mining areas of the world will see the advertisements for people wanting, companies wanting to hire people in those regions. We are starting to see that creep in as well. So in general, I think the inflation is going to be there, but with margins where they are today, if we're having 5-10% inflation, the profitability is going to be higher year on year because prices have gone up more than the rate of inflation.
Okay, so that brings us on a little bit back to valuation and perhaps the markets reading into the future of this inflation world. So, I mean, at the moment, I think EV/EBITDA is at the lowest since 1991. Net debt, I think, is at almost, I think, the lowest of any sector in the world. Ivan Glassenberg, before he retired, constantly said there's no valuation for this sector. Is this the harbinger of doom, or is this? Are we at the beginning of? Are we looking from a valuation perspective at some potential revaluation opportunity that really excites you?
Yeah, it's very difficult for me to talk about valuations specifically, especially on individual companies. But the data that we look at agrees with what you've just said around the strength in the balance sheets, the multiples that the companies are trading on relative to the past. All of this points towards an interesting entry point for investors into resource companies. I'd say one of the things that we see with regards to feedback from our clients is that they are wrestling with the conundrum around ESG. And they completely understand the outlook with regards to demand. They understand that the company valuations are where they are, and they see the kind of the intriguing valuation potential. But they also have to report back to their clients around the ESG and how that is being done within the sector. And I think sadly, the resources sector is always caught up with specific events that might be isolated, that tarnish the industry as a whole. And I think that the cultural impact of that has forced mining company management teams to nearly always be on the back foot. And this is something that we've been saying for a while, is that we would really look forward to the day when companies come out and are bold enough to be able to describe in a much more kind of constructive and exciting way the positive things that come from resource development around the world. And if they can start to talk about the impact they have on societies around where they're operating, they can start to talk about the infrastructure they're putting in place, the connectivity to communities that wouldn't necessarily have had any investment, the training, the education, the healthcare, the water, the digital connectivity as well. All of this wouldn't happen without resource development. And I think it's the time for the industry to think about this and be a bit more kind of courageous and reaching out and describing their role in true reality. Because when you look at a lot of the ESG reports that many people produce, they tend to only focus on the negatives. And we've been calling for a kind of ESG balance sheet to be produced, so you can see the bad stuff along with the good stuff. And I think that will help investors to make investment decisions to allocate capital in this area, and maybe that leads to rising demand for the securities, and we all know that what that means for share prices.
Well, anybody in this room who knows me would obviously not be shying away from the fact that obviously ESG is close to my heart at the moment, and much of what you've said over the course of the last 2 minutes or so has been replicated in what we've tried to do on ESG, and we'll come back to that. But I think there are a lot of people in this room who are either directors or management of smaller, maybe larger companies, but also investors who are trying to grapple and understand with the actual practicalities of ESG or sustainability as part of process in terms of raising capital. Perhaps if we could just come back away from the industry of where the mining industry is today and just try and understand the process with which a company goes into either BlackRock or potentially your peers and goes through this basis of, we know we've got to get the story across in terms of the resources, the reserves, the production, whatever it happens to be, but also the process then to get approval to gain investment now under the new world of stewardship and stakeholder engagement. Maybe just give us a little bit of feel for how that happens.
Yeah, I mean, it's for us, thinking about resource investment through the ESG lens has been something that we've done for decades, because it's been about risk management. When you have companies coming into you and talking to them about what they're doing on the ground, it's really important that we go and visit those assets and see what's actually happening. When we go there, we try and speak to not only the company and the company employees, but also what they're doing with regards to regional communities and regional government, and trying to understand their place in society and the impact they have to all stakeholders is an integral part of our investment process with regards to thinking about whether or not we should invest in a business with our clients' capital. And it's been a great way of managing risk, because if we can understand that a company is either liked or not liked, that will have a significant bearing on their ability to be able to operate and therefore capture the value that we're trying to share in with our clients. So that's how we tend to do it. I think what we're seeing now through tools like what you're developing at Digbee, is we're seeing more and more data coming out. And it's coming to us in a format that makes it, I guess, easier to look at companies across a level playing field. And I think once the industry as a whole, and this isn't just mining, but this is all resource, all kind of equity sectors, when we start to have that kind of level playing field established, those baseline studies, the uniformity of data in the way that we can analyze it, we can start to see which companies are doing a good job and which companies need to do a better job. And then that will give us the ability to choose. If we find a company that has historically not been doing a great job but could do a lot better, that's no reason for us to shy away from that company. Actually buying into their turnaround plan, the improvements they're delivering, if they're coming out with a strategy around the carbon transition, if they're going to have a positive impact in the world from what the activities they're doing, then, and they're starting from a low point, that we should be backing them on that journey. We shouldn't just be aiming to exclude them. So I'm really looking forward to more and more data to allow us to be able to make better informed investment decisions.
And just for clarity, is the process and the same for a larger company as it is for a smaller company? And what sort of differential is there? And should smaller companies who are looking for money and do know that ESG is on the radar when they go and talk to fund managers, how relevant is it for the smaller company, whether it's explorer or developer?
I think it's essential for all companies to take this unbelievably seriously. We wouldn't be investing in businesses that don't have the right processes. Obviously, the burden of these processes, the cost of them, the time that's allocated to it, is different depending upon what stage you're at. If you're a large producing company with lots of operations around the world, you're going to be spending much more money on this than if you're just a single exploration company, because you're at a different stage of development. But to start off, even at the very, very beginning, to start off with a culture that has ESG embedded within it, is something that you don't have a choice for. You have to do that, and I think it's going to be increasingly obvious to people who aren't signed up to groups like Digbee and others, where they can come in and present not only the financial information, the resource and the reserve calculations, the competent persons reports, the feasibility studies, but to have that ESG language wrapped into all of that is going to give people confidence that the company is taking that development very seriously.
So I had a fascinating conversation yesterday with a number of blockchain groups who are increasingly involved in the mining space, and I think it's probably taken a bit longer for this to kind of evolve over the last 2 years. But what was interesting and where the output of this is the potential for differential in pricing between arguably those that are green metals, where in other words sustainability effectively has been proven in the process the whole way through, and those that have just not embraced it. Do you see this differential taking place in coming years, or have you perhaps started to see this already?
Yeah, we're already seeing differential pricing for commodities based around those kind of metrics, and it will have a way of naturally playing itself out, whether or not commodities trade at premiums to current market prices because they have ESG credentials attached to them, or whether those commodities become the market price and commodities that don't have the necessary credentials trade at a discount. I don't know which one's going to play out, but there will be a gap, and we're already seeing that gap play out in certain commodities today. And I think if you fast forward into the very near future, if you're a copper producer and all of your power is coming from a thermal coal power station, and you're competing to sell your product into the market against a copper producer who has all of their power from renewable sources and much, much lower emissions data attached to its production process, it's right that that customers will pay different prices for those. Because if you are the end customer and you're trying to sell your electric vehicle, for example, to the market, and you want to be able to say that the carbon footprint of the production of this car was this amount, you're going to need to have the great level of integrity throughout your entire supply chain, and you will pay a premium to make sure that everything that's going into that good at the end of the day meets your needs, so that is inherent to the brand that you're then passing on to the final customer. So I am completely convinced that we will see this starting to come through. And it wouldn't surprise me if we had, the LME with, metrics attached to commodity prices, and those being kind of emissions data or ESG data attached to that, and blockchain has a role to play in being able to have the kind of the integrity of the system to be able to back calculate that.
Yeah, and the provenance of that data goes all the way back from the original exploration and development of that project. So, and within the blockchain, that can obviously then be validated. Just coming back to the kind of more juicier part, sometimes people would say with regards to M&A. So there's been ongoing consolidation, particularly in the gold space. It's been rather surprising with the kind of lack of deals done within outside of that, although I noticed yesterday the Capstone and Mantos got together. Do you see, particularly in the battery metal spectrum, do you see the risk of capital discipline continuing to be held a risk with regards to a lot of those companies, because OEMs and equipment manufacturers, the car companies and everything, and harking back to the 1970s, 1980s, when they got involved and they're trying to control the supply chain. Do you see that as a risk, that there are opportunities going to be missed as a result of this capital discipline that's been put onto these companies?
Yeah, it's a big topic, and I obviously can't talk about specific transactions or companies in this regard, but I'm getting a bit long in the tooth now, and when I started doing this job, when you looked at, say, the long-term price of copper and the assumptions attached to that, people were talking about 90 cents a pound was the long-term copper price, and copper price was trading at 60 cents a pound. It wasn't until kind of the early 2000s that we saw copper trade at 3 for the first time, I think 2006, 2007 timeframe, and we've been kind of using a long-term copper price of 3 plus now for over a decade. We now know that when you look at a commodity like copper, if you're building a new big copper porphyry in South America, you're having issues around water. You've got to put desalination plants in. That's an enormous amount of additional capital. There are huge numbers of additional burdens that you need to do with regards to the development of those projects. So the capital intensity has risen substantially. And so when we think about this in the context of M&A, it wouldn't surprise us to see companies start to use, higher long-term prices than the numbers that we've seen being used over the last few years. And in fact, some of the transactions recently, if you back calculate it, do imply those kind of $3.75 plus number for copper, and some, I think one recent one was above 4. So things are definitely moving. To come back to your point around capital discipline, there's clearly an arbitrage in the market right now between the value of a producing asset trading on the multiples that it does versus a development project with all of the risks attached to that development, all of the capital costs and cost inflation attached to that, the startup risks, what's the market going to be like when it comes into production, et cetera, et cetera. And that arbitrage I would expect to start to close out, and most likely probably through M&A. I do hope, though, that we as investors can rely on the companies to continue to be disciplined in the way that they allocate their capital. I think generalist investor memory of the value destruction that came from the previous cycle is still fresh, despite it being almost a decade ago. And I think if you start to see people being less disciplined or irrational, chasing growth for the sake of growth, that's going to be damaging to multiples and to credibility. And I think if companies still need to explain to their shareholders why a deal makes sense, and it can't be just because you're getting bigger.
Okay, and just while we're on M&A, but tying it in with ESG, do you see ESG as a hindrance or potentially friction to allowing M&A to happen? Is it something that is getting in the way of M&A?
I think at the moment, ESG is definitely a greater part of the due diligence process in doing M&A. I think what's getting in the way of M&A today, and most recently, has been COVID, because of the inability to do due diligence because of travel restrictions. And I think some of there are a couple of transactions recently where we know that no due diligence was done on site because people were unable to get to those facilities. And I find it extraordinary that businesses can do M&A with all of those risks and be unable to to do that level of very, very basic work. To me, that's a massive oversight. But I think in general, absolutely, there is a far greater focus on ESG and the risks attached to it, especially around legacy assets. So a business, if you're buying a business today that has been created with the merger of lots of other businesses through time, there's going to be a long ESG history or trail that needs to be kind of audited and gone through.
Okay. And just in the interest of time, if anybody's got a question, we're going to come back with one or two potential questions in 2 minutes' time. Let's just touch on COP26. I think it would be a disaster not to answer that, simply because of the implication. It was amazing that there wasn't even a chapter for mining. There was obviously a lot of discussion around coal, but there was no chapter for mining, despite the fact that mining drives 45% of the world's economy. What do you feel as though the outcomes of COP26, how does that have an implication with regards to mining more generally going forward?
Well, clearly the biggest, I think, impact for us was thinking about demand. And it's so clear that the world needs to move incredibly quickly to be able to deal with the risks around climate. And it's not going to be possible to deal with those risks without resources. The infrastructure investment is trillions of dollars, and it's going to be at a high rate of investment for many decades. And so it comes back to that first point I made around the demand outlook. So that's the first thing. I think the second thing with regards to COP26 obviously is the focus around emissions. And I think that when we start to think about that in the context of the mining industry, I hope that we see the industry move more rapidly to outlining their clear plans around the carbon transition. I think the industry would be crazy to start avoiding ESG capital that needs to be spent on their individual journeys to be able to help deliver their own component of what is needed around the carbon transition.
Last question from me before we go to the audience. You gave a really fascinating interview with Mark Bristow at another conference in March last year. Do you, just harking back to that interview, do you feel as though there's too much focus on the carbon side of it and not enough focus on the, shall we say, the other 30-odd different topics, the social side of it, the nature side of it, to some extent governance as well? Do you feel as though there's an imbalance within this whole sustainability conversation?
No, I think it's right to focus on carbon because that's the one that's probably most pressing in the near term, and it's probably something that with current technologies is going to be something that could be tackled if the money is spent. I think it's important though not to only focus on that. I think every component needs to be focused on, and I think what we're now seeing is a dramatic increase in the focus on natural capital, and that's certainly something that we're doing at work. Is allocating more resources to look at that and to see how we can get companies to invest more to be able to protect the environment outside of just cutting emissions. And I think that is an area that's going to have increased focus and dramatically increased spending. The challenge on that is to be able to find a way of independently auditing it and making a difference, because I think that area is still very new. And there's lots of, if you go back 20 years or so or more, 30 years, the data on safety that everybody was fighting over how to calculate, injury frequency rates, etc. That evolved, and everybody uses the same metrics now. Emissions is, coming to that same point. I think the area of natural capital is still very nascent today, and I think that needs to evolve quite quickly.
Okay. If I could just go to the audience, has anybody got a question that they would like to ask? The one down here.
Thanks, Andrew. Morning, Evy. I was wondering what your view is on the investability of hydrogen, please, particularly whether it be the ammonia space or also just the fact that we're going to be putting enormous pressure on water resources globally, and just whether that is ESG comfortable for us all as well as investable for us all.
Yeah, it's a good question, and I think one of the things I probably should have mentioned around COP26 is this, the high level of focus on what's called a just transition. And I think when we start to, as a developed world, we're all kind of rushing forward to try and do our bit. And what we run the risk of is leaving other parts of the world behind. And it's all very well for us to say, well, you've got to turn off your thermal coal power stations in certain parts of the world. That's not going to happen in the very, very near term until we get low-cost alternatives. I think the hydrogen element to this, as a society, as the world, we're going to need energy. And where that energy comes from, how that energy is transported, how that energy is generated, that's going to be integral to the world economy. And I think there are going to be different technologies that have different parts to play within that, especially as we go through the transition away from fossil fuels. I think the work on hydrogen is absolutely fascinating. I think there's huge numbers of challenges attached to it. It is, again, very, very early in nature, especially green hydrogen, or blue hydrogen, they're now calling it, how that's going to be produced. So I think there's a lot of work to be done. I think it's too early to be able to answer the question specifically that you're talking about, but we absolutely see a role for hydrogen in the economy in the future.
Andrew, have I got time for one more question? Anybody else in the audience like to give a question? Just behind you.
Hi, Evy. Just a question around what companies should do with their fossil fuel assets. Where do you stand? Do you think they should spin them off and divest, or should they manage them down responsibly? What's your opinion on that?
Yeah, obviously BlackRock's had a very public position on this and has had now for several years. I think it's the question that is one of the biggest ones in the market right now. And I think that there's a different way of answering it for different companies. And I think when you look at some of the approaches that some of the larger companies have done around putting assets into responsible runoff, that makes complete sense to me. Coming out saying they're not going to be investing capital back into those assets, putting them into a natural rate of decline, looking after communities, looking at training, reinvestment, etc. All of that part of the kind of closure process needs to be onboarded into their thinking. And I think there's a role for that. Other companies have gone down the path around exclusion. And I think there are positives and negatives for that. I think if selling assets to other people who can run those assets in a responsible way, in a public way, I think that's great. Putting those assets into private hands where they continue to operate, maybe even expanded in the opacity of being a private company, I think that's a more challenging way to describe your strategy.
Good. Well, thank you very much indeed, Evy. And thank you, Minds and Money, for having us again. And we'll hopefully be back in another year.